Well, we got a minor, and I mean a minor dip in the market over the past few days when the S&P 500 fell a measly 2%. But all of that was reversed when Jerome Powell took the stand at Jackson Hole to confirm what we already knew. Rate cuts are nearing. However, markets celebrated the news with all three major indices jumping more than 1.5% to close the week. But on that dip, we have seen some stocks take meaningful dips over the past month and a half. And those are the companies, the high quality companies that I'm searching out. As such, in today's video, we're going to talk about three stocks that I'm buying the dip on. One of them just reported earnings. So make sure you stay tuned throughout the entirety of today's video so you don't miss one of these three stocks. And before we unveil them, do me a huge favor. Show your appreciation for the videos by just simply clicking that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their top 10 stocks to buy right now. All right, let's jump back into our video, taking a look at three stocks I'm buying the dip on. Beginning with stock number one, which is going to be Intuit, stock ticker INTU. And when it comes to Intuit, this is a company that's been on my watch list for some time. They just reported earnings on Friday, and the stock fell 5%. However, it wasn't so much about what their earnings were, because earnings beat on both the top and bottom lines, which we'll look at here in a second. It was more because of the forward guidance. And you guys have heard me say this a bunch. It's less about what you've done for me as an investor and more about what you're going to do for me. That's the approach from an investor's mentality. When it comes to Intuit, the current market cap is $195 billion. Over the past 12 months, shares are up just 4%, and year to date, up just 3%, so lagging the greater S&P 500. So let's take a closer look at the latest earnings report, and for this I love to use finchat.ai. By going to the Intuit page, you're going to see the overview page, which will give you some more information on the company. You can see a chart over to the right. But if we go to this investors relations section here, you'll see the latest earnings transcript. You could see the report that they issued. This is their press release. And if the company issued any slides that pertain to the latest earnings report, you'll see that here as well. But when we go back to transcript, if you don't want to read through all of the back and forth by management and analysts and things like that, over to the right on FitChat, you can utilize their AI tool. By clicking the AI summary, boom, everything has just been summarized for you. We can see what total revenue grew, combined platform revenue, global business, other segments that the company has done. So this is on a year basis right here. If we click on the report, we can dive a little deeper. If you want to look at the fourth quarter report, we can see that revenues grew 20% to $3.8 billion. That's on a quarterly basis there, and some other quarterly information as well. So when we scroll down a little bit further here and see a snapshot of both full year and quarterly results, we could see on a non-GAAP basis, revenue came in at $18.8 billion. That beat analyst expectations. And earnings per share came in at $20.15. That's on the year. Down below, you can see the quarterly results. $3.8 billion, that beat analyst expectations, and earnings per share at $2.75 per share, that beat analyst expectations. So what was the problem? Well, if we scroll down a little bit further, we're going to take a peek at guidance. As you can see here, revenue is expected to come in at $20.99, we'll round up to $21 billion, growing between 12 and 13% next year. Non-GAAP operating income you can see there, and then non-GAAP EPS coming in between $22.98 and $23.18, growing between 14 and 15%. So again, when we look at that, it's less about what the company just reported, because as we could see, they beat analyst expectations on both the top with revenue and the bottom line with EPS. But looking ahead at guidance, we just went from a quarter in which revenues grew 20%, and now we're guiding to 12 to 13%. So yes, things are slowing, but I also believe management is being conservative. After all, this is going to be their first quarter. that they're coming into. And anytime a new year begins, a new fiscal year for a company, they tend to be more on the conservative side of things because they don't want to overpromise and underdeliver. That doesn't work unless your name is Tesla. In fact, the CEO of Intuit spoke about this in a recent interview on Friday morning.
Joining us now in an exclusive interview is the Intuit CEO. Seth, it's great to have you. So what happened here?
Well, first of all, thank you for having me. Well, let me just start with the year, and then I'll get into guidance. We had a spectacular year. We grew the top line 16%. Our margins expanded over 40%. And we've got momentum as our Q4. We had 20% growth. You know, as we look at guidance, I would say a couple of things. We guided 12 to 13% top line growth and another year of margin expansion, you know, at our scale, well over 20 billion. And a couple of things I would say. One is we're being prudent. It's the beginning of our fiscal year, and we want to make sure that we continue to carry the momentum into the year and exceed expectations.
So from that, you could see how some investors get far too fixated on those headline numbers, revenues, and earnings per share. But really, it's about the internals that I focus on, investor. And it is what allows me to beat the S&P 500 year in and year out. I'm looking to buy high-quality companies at great valuations. And Intuit is just that, with a diversified set of products. Let's jump back into Fiscal.ai and take a peek at their financials over the years. And if you want to try out this amazing platform where I perform all of my research, you can try it out for free using my link down in the description below and get 15% off any paid subscription moving forward. It's a must for me and gives me a huge advantage with investing. But looking here, look at the growth in the company's performance. Revenues making new record highs, operating profit making a new record high, EBITDA margins expanding to over 30%, which is fantastic. And more importantly, check out their free cash flow, which has exploded to $6.1 billion on free cash flow margin of 32.3%. Turning now to valuation, things are looking very intriguing as the stock trades at a forward PE multiple of 28.8 times, well below the company's recent average of 31.5 times. EV to EBITDA trades at 32.6 times, well below their average of 38 times. So is growth slowing? It could. It happens to all companies as they grow in size. But we just saw a 20% top line revenue growth. And this is a management team that historically, and this is the case with many management teams out there, they're conservative going into a new fiscal year. This smells like opportunity to me. And when it comes to analysts, they tend to agree, as the average 12-month price target for the stock is $837 per share, providing for more than 25% upside from current levels. So when it comes to Intuit, I took advantage of this dip and started a new position in the stock. And now we're going to move on to stock number 2, which is going to be Equinix, stock ticker EQIX. And for this company, it's one that I've already had in my portfolio. So it's not going to be an entirely new position, but given where the stock is at and given the fact that interest rates are coming down, and this is something that we've been talking about within my Discord community, the Stock Investors Edge, which you can get access to using the link down in the description below. We'll get my daily market talk. You're going to get access to my portfolio, stocks I'm buying and selling, all of that by becoming a subscriber to the Stock Investors Edge. But in there, we've been talking about the impact of lower rates on the REIT community, or the real estate sector, I should say. This is a sector that's very interest rate sensitive. And we've already known, and now we've kind of got confirmation, rates are coming down as soon as the next meeting here in September. They may not only come down once, they may in fact come down twice. And that's going to be a tailwind moving forward for the REIT sector. When it comes to Equinix, they currently have a market cap of $76 billion, making them one of the largest REITs by market cap. And over the past 12 months, shares are down 4%, and year to date, down 16%. Because of how REITs are formed, they rely a lot more heavily on debt, hence why rates coming down is a tailwind for that community. And I believe that looking out 12, 24 months from now, you're going to look back and say, I wish I bought more. Now, not all REITs will participate in the upswing because they still have to perform. But if you believe in this AI boom, then you know data centers are a huge need, and Equinix is the largest data center REIT on the market. There's plenty of runway ahead. Let's jump back into fiscal.ai when we can see this is yet another company, despite what interest rates have been doing, that continues to grow. Revenues over the past 12 months have increased to a record $8.9 billion. Adjusted funds from operations, or AFFO, are at a record $3.56 billion. That growth allows the company to pay a safe, reliable, and growing dividend. And as you can see on your screen here, the stock currently yields a 2.4% dividend, with a 5-year dividend growth rate of nearly 12%, which is impressive for a REIT. Very few REITs are considered a dividend growth stock. Turning now to valuation, things again are looking quite intriguing, as the stock trades at a forward price to AFFO of 19.8 times, well below their 10-year average of 22.7 times. This AI boom we continue to go on continues to be intact. Data centers are a huge need, which puts forth a huge runway for Equinix moving forward. Analysts, they tend to agree, as they have an average 12-month price target of $950 per share on the stock, giving way for nearly 20% upside moving forward. So with Equinix, again, a REIT already in my portfolio, and I added to that position this week. And that leads us to stock number 3, which is going to be ServiceNow, stock ticker NOW. Now, this isn't a stock that's currently in my portfolio, but up near the top of my watch list, a stock that I will be buying. And for those of you unaware, this is a software-related company that helps with tasks related to HR and customer service, and they're finding ways to implement AI to help businesses of all shapes and sizes. When it comes to ServiceNow, they currently have a market cap of $182 billion. Over the past 12 months, shares are up 8%, but year to date, down 16%. So as you can see here, all 3 stocks that we're looking at here today have underperformed the S&P 500. So we know we're not chasing any stocks. And when it comes to software-related companies, they've really been lagging the market over the past few weeks. And as we can see, ServiceNow is down roughly 15% just since the start of July. As an investor, it is so important not to get all involved in the stock hype, because looking back just a few weeks ago when the company reported their latest earnings results, everyone was up in arms, happy with the results. The AI monetization, stock jumped more than 5%. But again, if we go back to fiscal.ai, we can get a quick summary of those results by again clicking on the Investor Relations tab and then showing us an AI summary of their latest earnings call and report. We can see subscription revenues grew to $3.1 billion, up 22.5%. Total revenues up 22.5% to $3.2 billion, and current remaining performance obligations, or RPOs, up 24.5% to $10.9 billion. Those are dollars that will eventually turn into revenue dollars. And the company continues to find ways to incorporate AI into its service offerings. Looking at the latest results in fiscal.ai, we can see revenues at an all-time high of $12.1 billion, operating profits at a record high of $1.6 billion. This was a company operating at a loss up until 2020, and now we have operating margins at an all-time high of nearly 13.5%. We have a mixture of growth and efficiency taking place at ServiceNow, 2 things I love to see growing at the same time. Jumping back to fiscal AI, we could see the free cash flow of the company continues to grow as well, allowing for more reinvestment for future growth. Free cash flow over the past 12 months sits at $3.8 billion. The internals of a business are so much more important than focusing purely on the headline numbers, revenue, and EPS. I care way more about the internals, and that's how you find undervalued stocks. I'm going to talk a lot about this in my upcoming 2-day valuation workshop, which is going to take place on August 27th and August 28th. You will be able to join me live, and even if you're unable to join live, you will get the recording to the workshop as well. You can check out all the details down in the description below. Hope to see you there. Let's jump back to Fiscal AI, where we can take a peek now at valuation for ServiceNow. And again, this is still a fast-growing, younger company, so valuation is going to be much higher than the others we've looked at today. The forward PE multiple currently sits at 48.8 times, well below their recent average of 67 times. EV to EBITDA sits at 64 times, well below their 5-year average of 97 times. Now, again, those averages are high because of the stage of where the company's at. I do expect those to come down over time. And if we can get this stock back below an $800 per share, that's the area that I'm targeting to start initiating my buy into ServiceNow. And when it comes to analysts, they're also upbeat on the stock, giving it a 12-month price target of $1,151 per share, making for nearly 30% upside from current levels. So again, with ServiceNow, not a stock currently in my portfolio, but at the top of my watch list, aiming for something below the $800 per share target. So there we've looked at 3 stocks to consider buying the dip on, 2 of which I already have bought the dip on, a brand new position, one I've added to in my position, and one at the top of my watch list. Let me know in the comment section below, which of these 3 stocks would you be willing to buy at current levels, and which are you going to pass on right now? And if you haven't done so and you found any value in this video, do me a huge favor, as I truly appreciate it, by simply clicking that like button down below. I hope to see you in our 2-day valuation workshop, August 27th and 28th, where you're going to get the complete recording, any of the PDF and handouts that we go through. As a viewer of that, you will get access to. So thanks again for watching, and we'll see you in the next one. Take care.